All right, so thanks for attending the webinar today. On the line we've got Geoff Wilson from Wilson Asset Management and Gabriel Radzyminski from Sandon Capital Investments. I just thought we'd do a webinar today just explaining the offer from Sandon, and prior to that I'll just get Geoff running through the listed investment companies and just giving us a brief overview on how they work. Before I do that, I've just got to go through a quick disclaimer with you just to explain that everything within today's webinar is general advice only, and if you're unsure about anything, you should take personal advice, and you should always read the product disclosure statement. Just to give you a bit of background in terms of us as a company, we've got two sides of the business. We've got the non-advice side where we try and show a little bit of analysis and we put the offers out there for you to invest into. And then we've got the full personal advice side of the business where we'll sit down with you, that's fee for service, and we'll look at what you're trying to achieve and how to construct a portfolio for you. Listed investment companies are one of the investments that we use within the portfolios, and that's how we've come across Sandon Capital and have a relationship with Geoff. So just to give you an overview on the listed investment company space, I thought bring online Geoff. Geoff, are you there?
Yes, Sorman. Yep.
Yep. Okay.
Look, thank you. Do you want me to start?
Yeah. Yeah.
Okay. Thanks very much for everyone who's called in, and Sorman, thanks for organising this. I think the reason why I've been asked to do the introduction, one is probably because over a period of time I've known Gabriel, and that was before he set up his own business, which was 5 or so years ago. And I was always very impressed with what he did. He's looked at listed investment companies for a long period of time, and looked at investing in undervalued assets for a long period of time. The other reason I think why I'm here is we've got 3 listed investment companies, which we'll talk to a little bit later. We'll touch on that. But also, I'm a big believer in listed investment companies, and I've encouraged a lot of fund managers to start up listed investment companies. Justin Breitling at Australian Leaders, Carl Siegler's Cadence, and there's been a number of others. I just think they're fantastic structures. And why don't we've got two slides. One is on the features of listed investment companies. Why I, as an investor and also as a portfolio manager, think they're great structures is, as distinct from managed funds, you actually have a company structure and a board that's accountable to the shareholders. In this day and age, I think accountability is so important. So if as shareholders you don't like what the board's doing, effectively you can vote them off. If you've got your money in your managed fund, okay, you can take it out, but you really can't. If you're disappointed with how the manager is performing, there's very little you can do about it except just redeem your money out of those funds. It's a closed-end structure, and there's some real benefits to that, which I'll touch on in the next slide. And listed investment companies, the incredible thing is, one is the thing that frustrates people is the fact that they might trade at a premium to NTA or a discount, but to me that's one of the greatest opportunities you've got. So you can actually invest in a portfolio of shares, and at various points in time you can sell it above what it's worth, and you can buy it below what it's worth. If we flip over to the second slide, which is the benefit of listed investment companies, effectively a lot of studies have been done. A lot of studies have been. For a moment there, Geoff. Can you just start again? Okay. In terms of the benefit of listed investment companies, that's the second slide. A lot of studies have been done that showed that as a diversified portfolio of shares, that they outperform managed funds. and why do they outperform managed funds? Is because what happens with managed funds, when the market's going well, all the money comes in, and the fund manager is forced to buy expensive stocks. When things are bad, like the GFC, all the retail investors take their money out of the managed fund, and the fund manager is forced to sell stocks that he knows are cheap.
Hang on a second there, Geoff.
Yeah, someone's creating a bit of ruckus in the background there.
Yeah, I was wondering if it was at your end or it's.
No.
Just give me a second.
It's quieting down now.
Okay. All right.
Yeah.
Okay.
And in terms of like a managed fund, money gets pulled out, as we saw during the GFC, and those fund managers that are managing that money are forced to sell companies they know are cheap. Now, a listed investment company is a closed-end pool of capital. You can buy and sell the shares. They can trade at premiums and discounts to NTA, but you're never redeeming the money out, and so the fund manager is never forced to sell anything. So he can take a long-term view. He doesn't have to worry about liquidity. He can buy whatever company he wants and knows that he will never be forced to sell it. So that's why over time listed investment companies outperform managed funds. So
what would you say? So you're saying that, I think you gave me an example when you saw big falls in the market, and you were comparing how listed investment companies were able to, because they were closed-ended, that for them was an opportunity, whereas you were talking about unlisted managed funds, there was issues with redemptions. Can you just elaborate on that?
Okay, I'll give you an example. We were buying during the GFC. We had a level of cash, and as the market was falling, of course, we were looking at buying opportunities. And there was, I remember shares in McPherson's that a fund manager had redemptions, and they were a forced seller. And they started selling them at 90 cents. And I think that their last line of stock got sold at 32 cents. We started buying at 38, and we ended up selling them at $3, I think, after the GFC washed through. So that's just an example of the person who has redemptions being forced to sell stock. And sometimes
why wouldn't an unlisted manager be able to do the same thing in that scenario? Why were you more?
It's impossible. If the unlisted manager is having money taken out of his fund, say the unlisted manager has a $1 billion fund, and he has $100 million of redemptions, then he has to sell $100 million worth of stock, and he's got to sell it at whatever price he can to meet those redemptions. And you tend to find when the managed fund has redemptions, it's usually the worst time to sell stock because the market's fallen, liquidity's dried up, and they really it really pushes the price down significantly. I remember I've seen this. I've been in the market 33 years, and I've seen it every 10 or so years. There's a bit of a crisis, and as fund managers, we get phenomenal opportunities because we're never forced to sell any stock. Because if, say, in a listed investment company, you've got $1 billion in there, then it's there, and people can buy and sell the shares, but you never get redemption, so you're never forced to sell a company. So, and also you can take a medium long-term view, where if it's a managed fund, you've got to look at your liquidity of money coming in and going out all the time, and you can't really take as longer-term view as if you manage the money in the listed investment company structure. So it's just a superior structure, and all the research shows you it's a superior structure. plus you have the opportunity that at various points in time you can sell it above what it's worth and buy it below what it's worth. Mm-hmm. If we flip over to the next slide, there's two slides there, slide 4 and slide 5. It just shows you that at various points in time shares trade at, the listed investment companies trade at above what the assets are worth and below what the assets are worth. Now, I know from our perspective as a fund manager, every stock we own, how we manage our money is we're trying to make money on every trade we do. We're not like a traditional fund manager that just is looking for the exposure to the market, looking for the cheapest stock, even though he thinks the market might be expensive. If we don't think we can make money in a company, then we'll sit in cash. So in theory, when you look at our NTA, and I assume Gabriel's NTA will be similar, he can sit in cash too. Some people say, the biggest reason people sell our shares, first is they need cash for something. The second is because it trades at a premium NTA. But what you've got to remember is NTA, which is the value of the assets we own. Every share we own is we think we're going to make money on it. Otherwise, we wouldn't own it. So it's a little bit different to some other managed funds when you look at it. To me, the interesting thing is really Table 5, where you see the premium discounts for the smaller listed investment companies, and our 3 listed investment companies are trading at premiums to their NTA. So if I was trying to buy something, we try to buy discounts, not premiums. But it was really interesting to see that heavy blue line is how well the smaller listed investment companies, I suppose ourselves in that category and Gabriel will be in that category, how well they've done. And then we've just got the 3, the next slide just shows our 3 listed investment companies. So will I pass over to Gabriel now?
Yep, just give me a second. Seems like we're having some problems with the audience listening in on it. Just a moment. Okay. All right. So we'll carry on, and then I'm going to put recording out to investors afterwards anyway. So let's carry on with it, and then I can forward the recording onto the master.
Yep. I'm going to kick off.
Yep.
Yeah. Okay. Look, thanks very much for having me here, Suleiman, and also thanks, Geoff, for that background on LICs. And I have to say, each and every one of those points that you've raised as to why they're a superior structure, I'm a firm believer in. I also think they're a fantastic investment structure, both for investors but also as a portfolio manager managing that fixed pool of capital. Now, what I'd like to do is just take you briefly through the presentation that we've got that talks about our initial public offering and our approach to unlocking value through shareholder activism. I'll turn to page 4 just as a start, and for those of you who aren't familiar, give you a bit of a précis on activist investing. So as we see activist investing, it has a very, very long history. Notable activists in our mind include the likes of Warren Buffett, Carl Icahn, and in Australia and the Southern Hemisphere, Ron Briley. Each of them have over the years carved out their own niche. There are countless others as well. And from our perspective, what we see in activism is that it is a very logical and necessary extension of value investing. To us, value investing without the activist component is almost like hopping around on one leg. It's about, from our perspective, doing things once we've identified a potential investment to unlock that value rather than simply hoping and waiting for other things and other people and other factors to realize that value. One of the other points that we do stress is that we're trying to reduce the uncertainty of investment outcomes, though by no means guaranteeing them, but we're looking to reduce the uncertainty by actively working towards a particular outcome that we think is a profitable one for us and other shareholders. We're always looking to use the rights that are available to all shareholders in Australia. As an aside, corporations law here we find is very shareholder friendly on balance. There's a lot of tools available to shareholders to put forward their views, and they're very well codified rules. At the end of the day, all things aside, activism for us is simply a tool, and the goals for us are very, very straightforward. We're looking to try and find opportunities where we can buy $1 of value for much less. And then what we're working to then do is extract that value that's available. On page 5, we've got a graphical illustration of what we would best describe as the activist's toolkit as it applies in Australia. This is by no means comprehensive, but simply to illustrate. And what we're showing in that slide is, if you imagine that you are buying an asset, you're buying something that has a discount to what we consider its intrinsic value, and that's effectively you start off with passive ownership, and then as you move up the activist spectrum, applying all of those tools that are available, you're looking to bridge the gap and narrow the discount between price and intrinsic value. Over the last few years that we've been running Sandon Capital, we've effectively used all of these and more, and a number of them we've used repeatedly. Now, in terms of a brief introduction to who we are, Sandon Capital is effectively an investment management firm as well as an advisory firm. So we specialise in activist investing generally, both as an investor and as an advisor. And in our advisory practice, we've been behind a number of very successful and high-profile activist engagements. Geoff, it's no coincidence that we're able to secure Geoff to speak in an introductory capacity today. Geoff is one of our long-standing clients. We have worked with Geoff, for Geoff on his activist positions for a number of years. And examples of our work include RHG Limited, where we were the advisor retained by Geoff Wilson and Cadence Capital. We worked on the Alesco Dulux battle, where again we were retained by one of the investors who owned a significant stake in Alesco to try and ensure that a fully franked dividend was paid as a result of the takeover of that company. Australian Infrastructure Fund, Signature Capital, and countless others. We've had, I think, 14, 15 activist engagements over the years, all of which have been profitable and successful. We're also the manager of 2 wholesale funds, the Sandon Capital Activist Fund, which was established in 2009, and our institutional fund, which was established this year. Both of those are rated by Van Eyck, but the company is not rated by them. That's only something that applies to our fund. In terms of our investment strategy, briefly we'll be looking to invest in listed securities that, in our opinion, exhibit value characteristics and whose prices may benefit from activist engagement. It'll be managed in a very similar way to our existing wholesale funds. All investment decisions and all investment allocations will be made on a pro rata basis across all of the funds to the extent that the mandates are the same. And overall, from our perspective, we are completely agnostic about benchmarks in the market and the market generally. Our focus is on effectively delivering an absolute return. That's what we aim to deliver. And in terms of the types of investments that we're looking for, I've described them previously, but also one of the points that we would make is we do try wherever possible. It doesn't always work that way, but we do try to find situations where we can stack the odds in our favour. We are not investing other people's money with a view to playing fair. We're looking to invest to make a profit. So where we can structure or somehow coax a situation where we get a good outcome no matter what happens, those are the sorts of things that we really like to do. We're also trying to find situations that we would describe, for lack of a better expression, as option-rich, where there are a number of options that could materialise, which could deliver value to us. We don't want to stack everything on one outcome. For us, that sort of binary approach to investing is not what we like to do. Sometimes it happens, but it's not the intention. but basically we are trying to do things so that whatever happens, we do get a positive result out of it. I'll touch briefly now on the highlights of the offer. So Sandon Capital Investments is the company that is raising money. It's worth noting here at this point.
Sorry, Gabriel, just interrupting you here. So which slide do you want us on still? We're still on slide 4.
Sorry, I'm on slide 8.
Slide 8. Okay, hold on.
Sorry about that. I should have given the commentary.
Okay, all right, so slide 8. Okay.
Okay, so slide 8. Here I'll touch briefly on a bit of the background to the company, because Sandon Capital Investments is not a new entity. It's actually an entity that used to be known as Global Mining Investments Limited, which was an ASX-listed investment company. At the time, it was an investor in, as its name suggested, global mining securities. But in late 2012, the then board undertook a restructure of that entity, which involved effectively the gutting of it. It took all of its assets out, and those assets were transferred to an unlisted managed fund, which continues to exist. And there was a shell that was left with about 5,500 shareholders, and that was to be liquidated. Now, Sandon Capital, we're always looking for opportunities, and in our own right, we bought 14.9% of that entity with a view to preventing it from being liquidated, and on the basis that we thought there was something better that could be done with it, namely this. From our perspective, it gave us, we were successful in that. It took quite a while. It took, as we would say, 2 of the key attributes in the activist game are persistence and patience. And that persistence and patience paid off in that we were able to gain control of a shell that had 5,500 shareholders to whom we could legitimately market our product. We're keen to get as many of our existing shareholders to consider reinvesting further capital in this, but that's the background to the company. Importantly, there is no, other than the fact that it was renamed, there is no legacy, there are no legacy assets in the company, in that all of the assets were taken out of the business at the point of restructure.
Which is actually one of the points I've had from a number of investors. I think the concern was, are you going to be investing in mining stocks? You know, so which I think you've answered. Presumably not. It's just the shell of the previous company that you've taken over.
Correct. Look, we may from time to time, Suleiman, invest in resource companies, but not because we're taking a view on resources, but rather because, for example, at the moment we're doing a lot of work on a number of companies that are trading below their cash backing, and so we're looking to see whether there are not means by which we can get the cash back into our hot little hands. But they're not. When we do that, it's really not a view on the resource space. We're not particularly inclined that way.
Okay, and am I correct in thinking that Global Mining Investments also had something along the lines of $3.3 million in unused franking credits? Is that still the case?
Yes, it is, Suleiman. So what happened there, just by way of background, when the company restructured itself, it had to pay out as much as it could in fully franked dividends, but unfortunately at the time they didn't have enough profits, and so the company was left with a franking account of approximately 3.3 million, and that continues to be the case today. So from our perspective now as Sandon Capital Investments, if we can generate some profits, those franking credits should be available to us to help frank the dividends.
Okay, great.
Now, in terms of going back to the offer, so what we're doing at the moment is we're raising money by way of shares priced at $1, and also a free attaching option for each share that is subscribed for. Those free attaching options have a maturity on 24 July 2015, so approximately 19 months, and they allow people to exercise them at any time at an exercise price of $1. That's just the
okay. And will the options be tradable on ASX?
Yeah. Both will be listed. So the proposed ASX codes will be SNC and SNC0. Oh, sorry, SNCO, I should say. Apologies for that. Now, in terms of the
I think just to also give listeners an idea, we value that at somewhere between 6 and 8 cents. I think when some of the brokers have put a value on it as high as 11, 12 cents.
Yeah.
But, you know, that in itself has a value for investors as well.
Look, it does have a value. Yeah, it does have a value. You know, interested to hear your range. The brokers, I think that I've certainly seen, have a range of between 5 and 11. Some of the numbers that I've seen. So, what I think the point to make is, yes, there is value there. What they will trade for on the market, we will find out once they start trading. But whether the valuations reflect, or whether the market price reflect valuations, time will tell. But yes, there is some value in those options, even simply by virtue of the time value that they include. Now,
okay. Can you just give us a bit of background on the timetable as well?
Yep, sure. So basically, the offer is open now. The offer is expected to close Friday next week, so that's over a week to go before it closes. Then the shares should be listed. We're expecting allotment mid-December. 16th is the tentative date. Holding statements to go out after that, and we're expecting the shares and options to commence trading on the 27th of December. Now,
the way we suggest our listeners to apply is that they can ask us for an allocation through the broker firm offer, and we'll come back to them on Monday and let them know how much of that they've received. Geoff, who's, I don't know if he's still around, but Geoff also has a priority allocation.
Yeah.
Is it about $10 million, 10 million shares?
Yeah, Geoff asked us to set aside 10 million priority allocation for all of the WAM shareholders.
Yeah, and then there's the general offer. So people who receive our newsletter, the way they'll normally use us if they've got access to a priority offer and a general offer is they'll apply through us initially, see what they get. If there's any scale back or they want a top up, they can then go and apply through the priority offer. If they haven't got access to that, they can apply through the general offer as well. So I'm just moving on to your slide on page 11 with the performance. That's I think that speaks volumes in terms of how well you've done in the last few years. Notably with lower volatility, is that something that you'd expect to see in terms of the volatility? You expect to see the same type of volatility going forward, that you're typically lower than the market?
Look, we would like to see that. Obviously, I need to preface it, Sullivan, by saying that, you know, as always, our past performance is no indication of what the future might hold. It's perhaps even more true with the way we invest, in that the same opportunities that deliver those returns won't, by definition, exist in future. You know, so for example, there are companies that we you know, made handsome returns on that simply don't exist anymore as a result of what we've done. So I just preface that. But look, we tend to invest in companies whose share prices are already under pressure. We tend to invest in companies whose assets are typically tangible, and we're able to buy, when we can, at discounts to the tangible asset value. And we tend to buy companies whose performance or whose outcomes are very unrelated to what the general market does. Now, that's not to say that we're not affected by market movements, but we've found historically that the companies that we tend to favour don't necessarily move up or down in lockstep with the market. So the historic correlation of our returns to the small ordinaries, for example, is about 0.36. What that means for the future, I simply don't know. You know, we don't have a crystal ball. But we would expect, all things being equal, to be less correlated to the market than other more traditional fund managers would be. We also do tend to hold large amounts of cash over time.
Okay. So, what else was I going to? So I just had a couple of questions for you as well.
Sure.
Gabriel. I think it people just to understand how you actually got into this type of investing, because I suppose this is a little bit more than you'd normally see with a value investor.
Yep.
Being a bit more proactive. And maybe you could give us a couple of examples as well.
Yeah, look, I think the best way of sort of giving the background is, as you would appreciate, not all investments go to plan. We've made our fair share of mistakes over the years, and I think, like most investors, when you start out, you just think, oh well, things didn't work out. I'll cut my losses and move on. And over the years, we've faced situations where we began starting to, and this is in previous roles, where I started thinking, well, hold on a minute, just because something didn't go the way we expected it doesn't mean that we have to accept it. And the first, I guess the seminal moment was in a company called MMC Contrarian, which was a listed investment company that existed a few years ago. And
sorry,
there was
you just broke up just as you gave the name of that. Can you say that again?
MMC Contrarian. It was a listed investment company, and we one of the funds I used to run used to buy discounted investment companies, and we had just under 5% of that company, and then they announced plans to buy out their management company, and we looked at the numbers and the price they were paying, and we thought it stank. We thought it was a really bad deal. We thought the company was overpaying. It wouldn't achieve what they set out to achieve, and we didn't want them to do it. And so we started speaking to other shareholders to try and see if they would band with us to put up some resolutions to remove the board to stop it from happening. Because we'd spoken to the board, and the board said, no, we think this is the right thing to do, and we're going to do it, whether you like it or not. Well, we didn't like it, and we tried to do something. And that was really our first, or my first attempt at doing this, and not surprisingly, weren't able to get other people to support us. A lot of other investors said, look, we don't think it's necessarily the best deal, but let's just see how it goes. And we just weren't prepared to take it. So it didn't work, but what it did is it gave me a taste of what you could try to do when things didn't go your way. Now, it turned out in the end that that was a very, very bad acquisition for that company, and even more shareholder funds were lost afterwards. Fortunately, we sold our shares when we realized that we couldn't get the deal stopped. And that was effectively the beginning for me, where I suddenly realized that it didn't have to be the way companies wanted it, and that there was an opportunity. Now, notwithstanding the fact that it didn't work, i.e. we didn't get what we wanted, we got a very keen understanding for what was necessary. And so then over the years, just slowly but surely honed our skills. When I started Sandon Capital, one of the reasons I started it was that I realized very quickly in my former firm that traditional structures don't respond well to people who are operating outside of the norms. The companies, larger companies, I think often don't want to rock the boat. They don't want to unsettle relationships lest it has an effect on their corporate relationships. And from my perspective, having our own firm at Sandon Capital, which was unencumbered in that way, meant that we could simply do and invest the way we wanted to. And that's effectively what we did over 5 years ago now. And that's how I come to be here.
So, actually, how do you identify the opportunities in the first place? I mean, have you got a black book of incompetent managers that you follow around, or what? What's the process?
There are a few of those, Suleiman. The way I describe them a little bit more positively, in that there are some people out there who I describe as the gifts that keep on giving, in that we have a pretty fair idea that no matter where they end up, they might give us an opportunity. No, look, what we do is we have... Or
you could label that as the gift that keeps on taking.
Well, no, see, they take from others, but they give to us.
Yeah.
Look,
sorry, go on, you were going to say something.
Yeah, look, what we do is we've got a number of ways of identifying opportunities. We have we use Bloomberg as our main information or financial market information source in the office here, and we've got a number of value screens that we run in Bloomberg on a regular basis to just pop up companies that demonstrate and show value characteristics. And then what we also do is unlike most fund managers who are typically looking for better companies, they're trying to identify the best companies, we're actually trying to identify the worst ones, because we see the worst as being those where the shareholder base is probably most open to change. And so we look at companies that are hitting their 1, 3, 5 year lows in terms of rolling returns, because what we'd find there is typically if investors are suffering, that means they might be willing to listen to another view. Whereas if it's a company that's doing really, really well, they're not, no shareholder in a well-performing company is going to want to listen to some new people coming in and saying, hey, why don't you change your ways? They're going to rightly say, well, no, the current guys are doing a good job and go take a hike. So there are a few of our more quant-based methods of identifying investments. And then the thing now that we've got, certainly after these few years of doing this, is that opportunities pop up through our network. People that we speak to point us in the direction of potential opportunities. And we also get cold calls from investors and shareholders who suggest we look at a particular company for particular reasons. And we always have a look. Doesn't always come to fruition, i.e. we won't buy something unless there are two high-level factors present. First of all, there's got to be the valuation argument, i.e. we've got to be able to be convinced that there is a discount to the real worth of that security. And then the most important thing which overlays that is that we have to be able to form a view that there is a path to change. So there's no point buying into something if there's no chance, in our opinion, of ever affecting a change. What we need to do is to be able to see how we can do that. Now, that is a very subjective assessment, but that's what we do. We've done it for a while now. We do get a feel for the companies where either the existing shareholders might be willing to support change. Sometimes that involves actually speaking to them. But then also we look for companies where if we can share the idea around in a public way, that the share register might turn over and be replenished with more like-minded investors.
Okay. I think one of the ones that I'm most aware of where you've been involved in has been RHG.
Yes.
Perhaps I can just get you to explain that, because it's easier to go through a couple of examples to see how you've done this with investments in the past, for people just to understand the difference between somebody like yourself and somebody else who's just looking for cheap investments.
Yeah, okay. Well, look, so
I've got the slide up on RHG as well.
Yeah, we've got a worked example, or a case study, if you will, on, what page is it? Page 19, slide 19. So I think a lot of people are familiar with what happened at RH. So RHG floated just before collapse in short-term credit markets around the world, and effectively the company was on its knees. It was a business model that involved lending long and borrowing short, and as we all know, that can be a recipe for disaster when the market doesn't want to do that anymore. Let's just
explain who RHG are as well for people who aren't familiar.
Okay, sure.
That's Ram's home loan book, is that right?
Yeah, it used to be called Ram's Home Loans, and that was a non-bank mortgage lender, very successful business in its heyday, and it listed as the Ram's Home Loans group. But then when the GFC struck, they were on their knees. They had loans withdrawn, they had funding lines cut, and what they ended up doing was selling the Rams business, i.e. the mortgage origination business and that side of the business, to Westpac. And RHG Limited, which was the listed entity, simply then became the owner of a book of run-off mortgages. So it had at the time, I think from memory, $5–6 billion of mortgages that were in run-off. And despite the market turmoil, for those who looked carefully enough, the run-off book was effectively just spinning off cash. So as people repaid their mortgages, RHG was earning a spread between the price that it was charging its borrowers versus the price that it was borrowing money from, despite the fact that there was a global financial crisis, and it was creating a lot of cash. It was practically controlled by John Kinghorn, a very successful entrepreneur who founded the business. And they simply, because they needed to accumulate cash to ensure that they were able to maintain their credit lines, RHG was not paying any dividends. And a lot of investors piled into the stock at very low prices. For us, when we started our wholesale fund, it was one of the first investments that we put into the fund. At the time when we started the fund, the shares were trading around 50 cents, and that was the price we paid. Some others bought, for example, Geoff Wilson had been an investor prior to that. And so everyone was sitting there waiting and watching the cash accumulate. And then at one point, people started putting pressure on the board to start paying dividends, and they didn't want to do that. They kept citing the uncertainties in the market and the fact that they needed to retain cash. And eventually, the board put forward a proposal that was, in very simple terms, was a lowball buyout by John Kinghorn. He was offering to buy the company back from people at 88 cents a share. And the thing that really stung most of the investors was the context of the buyback was, we're going to buy back shares and we're probably going to delist the company afterwards. So he wasn't saying that you had to participate in the buyback, but he was saying, look, anyone can choose not to participate, but if you don't participate, you've got to be prepared to be in a delisted company. And so for a lot of the fund managers who were in there, they couldn't hold unlisted assets, and the price at which he was proposing to buy back the shares was very, very low. Even at the time, the independent expert had a valuation of between 96 and $1.31, 96 cents and $1.31, and there was $1.16 of NTA when he was trying to buy it back at 88 cents. And so we were a holder as well. We weren't happy with the delisting proposal, or the consequence of the buyback that could be delisting. And so we were retained by, first of all, Geoff Wilson, and then subsequently by Geoff and Sandon Capital, to devise a strategy to stop Kinghorn from delisting the company. And effectively what we did, and John Kinghorn came to the market and had and still has a very fearsome reputation as a businessman, deservedly so, very talented, but also very aggressive and very competent at what he does. And a lot of people didn't want to go up against him, and so that was not an issue for us. What we were able to do was to help devise a strategy that involved giving people effectively a free option. And the free option I'm talking about is that the timing between the buyback proposal and the buyback meeting and the meeting that Geoff and Carl had requisitioned to remove the entire board, there was about a 6-day window where people could effectively vote against the buyback, but then if Kinghorn was successful, they could still tender their shares into the buyback. And that was really one of the things that allowed a lot of people who were otherwise quite wary of going against Kinghorn, because what people didn't want to have happen was to throw their stock into our camp, only to find that we didn't succeed, and then to find that they couldn't accept the buyback. Yeah. And so what we were able to do was to explain very clearly to people that they had an opportunity to, if you will, have their cake and eat it. They could try and vote Kinghorn down, and if they failed, then they could still participate in the buyback. And that was, that was a way of making it easy for people to support the proposals that we had without necessarily being detrimental to them if we weren't successful. And in the end, we were extraordinarily successful in marshalling all of the shareholders of RHG who weren't Kinghorn related into voting against the buyback. That then prompted the board to declare a special dividend, and that was basically, it was as though the dam burst. Dividends have then flown from that entity. There's been over $1.21 of fully franked dividends paid, keeping in mind this was a company that they were trying to buy back at 88 cents. And then most recently,
$1.21 plus the franking.
Plus the franking. And now the company is the subject of a scheme of arrangement that will, if it's approved, will involve the payment of 50.1 cents a share. So, and I'm still on the board. I was invited to join the board after we voted down the Kinghorn proposals, and I'm still on that board now.
Well, actually, I do the other thing I was wondering was, what do you actually do if you're facing a hostile board? And I can't actually see them ever being happy to see you.
No, that's a fair point, Sullivan.
What do you do? Do you just sit tight if you've got enough shareholder support, or do you just try and move on with a hostile board?
No, we don't move on. Look, if we think there is a chance that we will succeed, a good chance we will succeed, we will encrust ourselves there like a barnacle. You will not get us off. I mentioned before, two of the key attributes of this type of investing are patience and persistence. Patience in that you need to bide your time to ensure that you have as many factors in your favour to yield the right result. So sometimes it means that we have to sit there quietly and patiently and just wait. In some situations, it's a case of literally just paying out the rope and giving the board enough rope to hang themselves. Because again, normally the sorts of companies that we target, they're pretty stuck in their ways, and so they'll usually keep doing what they're doing. Some will even do more of what they've been doing simply because we've said do the opposite. And it's just a case of being very persistent. Geoff talked about before that the long-term benefits of a closed-end structure, and I think that's one of the really powerful tools that we have here. He and I have had sat down with companies where we've been helping, we've been working for Geoff on particular matters, and we've sat down with companies where, for example, a CEO thinks that Geoff is just another fund manager and that he can see him off because, as all fund managers are, they're short-term. And, Geoff, goes on to explain the fact that it's a closed-end pool of capital, and effectively that the term of the pool of capital has a longer life than most CEOs have tenure. And that's an incredibly powerful tool to have in your toolkit when you're sitting down talking to someone who probably, on average, won't be in the job for more than 3 years.
So how long do you typically hold a stock for?
Oh, look, anywhere between 3-6 months and several years. I mean, for example, Warrnambool Cheese and Butter Factory, which is one of our currently in our wholesale funds, is one of our largest holdings. We've been investors in that since November 2010, and so we've just patiently held and accumulated stock in that. And now that's the subject of a number of takeover approaches, and from our perspective, we've got a bit of a wry smile in that it seems now to be degenerating into a reasonably hostile series of transactions. The one thing that seems to unify certainly Murray Goulburn, Bega, and us, and a few other shareholders, is that we're clearly not happy with what the Warrnambool board have done most recently in dropping the special dividend component of the Saputo offer. Okay, and the other thing I'm thinking here is that, look, we've just come out of the GFC. There was arguably a lot of undervalued companies having come out of the GFC. Are there going to be enough opportunities for you going forwards? Look, we think there are. We know there are, even in terms of what we're looking at for the year ahead. The one comment I would make, Sullivan, which, and we're often asked this, is the one thing that almost guarantees opportunity for us at the end of the day is human nature. People will always, from time to time, make decisions that are less than ideal. Those decisions might be self-interested, they may be conflicted, they may simply be bad luck. Whatever they are, we're there ready, waiting to take advantage of those, of the misfortune of those companies. We will sit in cash from time to time. Cash for us is an important tool of our strategy. If we can't find things to buy at the right price, we will simply wait. There I go back to our point about patience. There are companies that we have on our radar which we think are really prime targets, but for the time being the prices are just not quite right for us. And so we're happy to sit back and wait, and just wait until the opportunity materializes in a way that suits us. Okay.
Okay. Well, look, thanks, Gabriel. That's I think we've covered pretty much everything there.
No, thanks for your time, Solomon. Thanks to all your listeners as well.
Appreciate it. Okay. Oh, and sorry,
Okay.
I should also just recap. Look, if as investors, if you're looking to get an allocation, we've got the broker firm offer. We're looking for registered interest by Friday morning this week, which will be the, where are we, 29th of November. We'll probably have access to a little bit extra, or we may have access to a little bit extra. It depends on how the book build goes, and if there's any scale backs. But you can come and call us after that up until around Tuesday the following week. We'll let you know if we've got any extra allocation. I'd then say, following on from that, you've then got the Wilson priority offer available to you, and any applications that are made under that, if that's full, will automatically then go into the general offer anyway. So if you are a Wilson Asset Management shareholder, I think that's your second port of call. Am I right in saying that anything extra goes into the general offer, Gabriel?
That's correct. That's correct, Solomon.
Yep. Okay.
So there's effectively the two priorities are existing GMI shareholders, WAM shareholders, broker firm in general.
Okay. Great.
Thanks for your time.
Thanks for your time.
Good
Cheers.
afternoon.
Thank
Bye.
you. Bye.